Hello and welcome to the Can I Retire Now podcast with your hosts, Nick Russell and Becky Wagner. I'm your podcast producer, RJ Malik. Nick and Becky, how are you? Guys looking great. What do you got lined up for us today?
Well, thank you, RJ. Today we're going to talk about interest rates. Hot topic right now. So the topics we want to try to get through are basically who is the Fed, what happens when rates go up, what happens when rates go down, and how does this impact your life and therefore your retirement. So, Becky, where do you want to
Yes.
start? You want
All
to start with
right.
who is the Fed?
Yes, we're going to start with who is the Fed.
Okay.
And so in my mind, I know who the Fed is. I know it's short for the Federal Reserve. I get that. But I thought you should know what I visualize when someone talks about the Fed. Okay.
Okay.
I imagine this to be a kind of Wizard of Oz situation. Okay. Like a impenetrable kind of palace situation. And when you get inside, it is a lot like the Lincoln Memorial, like a very large person on a very large chair with proportional two buttons, an arrow pointing up and an arrow pointing down.
What do you call that guy? Is that Mr. Fed?
That is the Fed.
The Fed. Oh, he is the Fed.
It is a singular person. And likewise,
like the Hulk or the Iron Man,
yes,
he's the Fed. Got it.
And
okay.
when he pushes either button, it is similar to when we select a new pope, right? We get black smoke, like we're all just waiting and watching to see what the action is. So it's a very theatrical thing in my mind, even though I know it is, I know in my head it is none of that, but that's what I imagine, like this larger than life, very secretive, we don't have windows kind of situation, two big buttons up or down. How close am I?
I got to tell you, that's exactly what the Fed is. Exactly. But you know, it's 2024, so it's a giant woman in the chair. We want to be represented. We switched that out a few years ago.
Okay.
So close.
Probably no buttons though.
No, we lack the buttons. We have the technology now that we could do it automated. So the Fed is, like you said, short for the Federal Reserve. It's the United States' central bank. So it's been around since early 1900s, 1913, I believe. The whole concept behind the Federal Reserve is to stabilize our banking system, which is like their mantra. It actually, for anybody that wants to do some side reading, look up The Monster from Jekyll Island. It was one of the best books I've ever read. Your dad read it too. I referred it to your dad.
And it's about the Fed?
It's about how the Fed began.
This is not a good look for the Fed.
No.
Being called the monster. Okay.
It is not a good look at all, but it's a very factual book about how basically 7 of the wealthiest people in the world all met on Jekyll Island in Georgia, South Georgia, and generated this idea. The idea was we had all these massive banks, all these little regional banks started popping up, and they started taking market share. And this was how they could basically regulate, for people not watching the video, I just did air quotes.
Control.
Yeah, control.
Okay.
How money flowed through these banks to make sure that the big banks were still making money and making the bulk of it. So did not start with good intentions in mind. But they will move interest rates to either curb spending or inflation or other factors in the economy. And so that's why we always hear, oh, the Fed's meeting and the Fed might raise or lower interest rates. So very close to the giant statue with the buttons. But basically,
and it's in Washington, D.C., not Oz.
It's not in Oz. I can confirm that.
Okay.
Last time I checked. But
well, I'm going to continue with my visual. I think it serves.
Honestly,
I
think it's a better representation of what the Fed really is. So, man behind the curtain, he's got the big glowing head, kind of thing.
Yeah.
I guess that's Superman. That's more Jor-El Superman. Anyway, go ahead.
Anyway, okay. So that's the Federal Reserve. All right. So we hear
it's exactly what the Federal Reserve is, by the way. Anybody who's listening, that's exactly it by definition.
But it's more than one person.
Yes. It's an organization. There's a chairman or chairwoman, but it's a group of people making these decisions, economists and all kinds of things.
All right. So I watch the news every morning. Well, I watch the Today Show, which has 20% news in it. And they often talk about interest rates going
80% dog videos and babies laughing at stuff. Yeah.
It's a great way to start the day.
It is.
Okay. So they talk about interest rates going up and interest rates going down. So in my personal life, I feel like when interest rates go up, it's no good. So what happens when interest rates go up?
Okay. So I would agree with you. In a lot of cases, when interest rates go up, when the Fed raises interest rates, it kind of pushes these other interest rates. They're correlated, right? So they'll move with it. So you want to buy a house, you want to get a mortgage. Now your interest rate on that mortgage is higher. So a few years ago when they were at historic lows and everybody was getting a 3%, 4% mortgage, and now it's 7.5, 8 for some people, right? Your mortgage is going to cost more per month. You're going to pay more in interest. Same with car loans, same with student loans, same anytime you're borrowing money, which for people our age, a little younger, a little older, accumulating money, it's a big deal because we're usually borrowing money for something, right? We're borrowing money to pay our house, borrowing money for cars, school, college education, that kind of stuff. Believe it or not, interest rates going up can be a very good thing.
What?
Once they're up. So
tell me what happens then.
So the motion of them going up could be very challenging for investors, and we'll talk about that in a little bit. But once they're higher, Fed rates being higher also influences interest on investment products. So let's think of like a
double-edged sword here.
Yeah. So think about like a CD. Now we're young. We're
not the kind we play. Okay.
No, not a. Wow. There you go. Though I did bring a record home the other day. So that, I was going to say a little dated for reference.
All right.
But
so an investment.
A certificate of deposit, an investment CD. Yes.
Right.
That you get at the bank. Well, when interest rates, on your mortgage were 3%, CD interest rates were like 1%. You can get 1% for the year, right? Your savings account earned 0.01.
Okay.
Well, now that interest rates are higher, you can get a 1-year CD paying 5% or 4.5%. You can have a high yield savings account earning 4%. Well, for people, especially that are more conservative and are going to use those types of products or retired, therefore, need more flexible cash. Ooh, I just hit my mic. Need cash and stable investments. They're now able to earn more money on those investments than they were a few years ago. So it can be a very good thing for them.
Okay. So I did not know that aspect. I just knew higher interest rates cost me more money, but conversely,
cost you more when you borrow. But if you're not a borrower, it doesn't really affect you.
Okay. So then tell me what happens when interest rates go down, besides I pay less to borrow money.
Okay. So the opposite of everything we just talked about. Fixed products like your fixed annuities, CDs, savings account, all those interest rates go down. Cost to borrow goes down. But something we talked about maybe in our investment episode that I think is the most affected piece of the pie that impacts most people is bonds and fixed incomes, those types of products. So normally when we're talking about investing, people think of stocks. They think of I'm buying Apple and Amazon and all that.
Yeah.
But that's the growth part of your portfolio. The more traditionally we call conservative part of your portfolio is going to be fixed incomes bonds. And these are, money that's issued out or basically raised by companies, and they give you an interest rate and they say at the end of this term, I'm going to give you your money back, and you get the interest rate. So kind of like in theory, a CD, but now issued by a private company or a public company. But unlike a CD, there's no guarantee your principal is going to come back. So
really?
Oh yeah. So like
we haven't talked about bonds or CDs yet. So
we haven't. Okay. So, short, quick example of a bond is, let's say Walmart wants to build more stores. So they want to raise capital to do it. So they can go out and issue bonds and say, hey, Becky, lend us $10,000. After 5 years, we're going to give you your $10,000 back.
Okay.
But in the meantime, we're going to pay you 5% a year. Now, so it
sounds like a safe investment.
Sure. But Walmart could default and not pay you your $10,000 back.
Not a good day.
Here comes the interesting part. Interest rates move. So let's talk about what happens. Think of interest rates, and this is the example I give clients. I think it's the easiest way to think of it, like a seesaw. So you have the two ends of the seesaw, right? As interest rates go up, bond prices go down. So 2 years ago, the Fed raised interest rates considerably in 2022. We had the worst investment return year for bonds in 40 years because they raised interest rates so much. Now, why would it go down when interest rates go up? So let's use the example with Walmart. You gave Walmart $10,000. They offered you 5%. Well, now the Fed raises interest rates. So now everybody has to offer more interest to be competitive. Now Walmart wants to raise more money, and they come to me and go, Nick, I'll give you $10,000. We'll give you 9% for the next 5 years.
This doesn't feel good.
Doesn't feel good for you. Feels great for me.
Okay.
Right? Because now I'm getting 9%. Now, what happens, unlike with CDs, when you go to the bank, because there's no market movement on CDs, is that every day, both of our bonds are being priced just like a stock does, right? It's going to move around in value. And at the end of the day, if you hold yours to the end of the day, you will get your $10,000 back. But in that moment, as soon as Walmart issues a better option out there, my 9% one, yours isn't worth 10,000 anymore because they're going to price it.
No, I shouldn't say that word, but yeah.
Were you going to say scam?
I was.
No, it feels really ugly.
Yeah.
But they're always going to price it as if you were looking to sell it today. So if you turned around and said, I want to sell my bond so I can buy that 9%er.
Yeah.
What you're essentially doing is going to, let's say, RJ and saying, RJ, buy this agreement I have. You'll get 5% a year and you'll get $10,000 at the end of it. But RJ can buy the same bond I bought. So why would he buy yours? Because you're only going to charge him $9,000 or $8,500. You're going to have to sell it at a discount. So that is how the price winds up going down. Because in order to make it competitive for RJ, you got to give him a deal. And so you're going to lose money. You're going to actually lose principal in the moment, in the period. Now, of course, you hold it to term. Walmart agreed to give you your 10 grand back. So that's how you kind of get around that. But a lot of people, if you own a mutual fund or an ETF that owns bonds, they're buying and selling them every day. So the value of those funds will go down as interest rates go up.
Okay. I understood what you're talking about, but I'm going to say this is a job for professionals.
Yes.
Because it sounds complex.
It is. But let me give you the good news. So the seesaw works the other way, right? So now we're in an environment that the Fed's out there talking about lowering interest rates, right? So now we have these higher established interest rates. If you have CDs and stuff, it's locked in. Now, if they lower interest rate, well, I guess we'll do it this way, lower interest rates, bond values are very likely to go up because any of the ones in existence are now, let's say, paying that 8 or 9%. And I'm just using those numbers just as examples. And then in the near future, new issues are going to be paying the 5 you were getting. So now the ones that already exist are super attractive. And so now if I want to sell that, I don't have to sell it at a discount like you did. I can sell it at a premium. I can sell it to RJ for 11,000, 12,000, because now he's going to get this really high interest rate that no products right now offer.
Okay.
And so it could be really attractive for investors when rates are cut.
Okay. So inverse effect
seesaw
between consumers and specific investment opportunities.
I would say the direct or inverse relationship is interest rates, whether they're moving up or down, and the principal value of their fixed income of it, their bonds. Again, CDs don't matter. They're principal protected, guaranteed by the FDIC. Savings account doesn't matter. But these fixed income and bond portfolios, they're going to move like a seesaw. So if you see interest rates move, you have to be paying attention to that piece of the pie.
Okay. So this impacts retirement because ideally your investment portfolio would include some of these types of investments, CDs and bonds.
Absolutely. The older you get, and traditionally the more conservative you get, the more bonds and fixed incomes will play a role. To give you an example, if you were a moderate risk tolerance, middle of the road, 50-year-old today, a traditional portfolio would have 40% fixed incomes and bonds and 60% stock. So 40% of your portfolio is bonds. You probably didn't have a good 2022. And in fact, bonds haven't really returned much of a return since the financial crisis back in 2008. So it's been a really lagging behind.
Okay.
But I can't, predict the future. I don't have a crystal ball. But if the Fed now starts lowering interest rates over the next year and change, it could be a good time for those conservative investors. They could start to see some appreciation that they haven't gotten from that side of the portfolio. But yeah, if you just do a generic 60-40 portfolio, that's why it's probably underperformed what people are accustomed to over the last 10 years. Stocks, the 60% has done great. The 40% has really, really struggled.
All right. It's a little more complicated.
Yeah, I know you probably weren't expecting that. I could see it on your face.
No, I heard the words and I'm going to think about them.
Okay.
And probably ask you more questions later. So
that's what I'm here for.
Yeah. Okay. So interest rates are good. And the Lincoln Memorial guy with the big buttons.
Yeah.
All right. Is controlling a lot of different things.
Yeah. And to just some insight, the Fed is meeting pretty regularly now. As we sit here, we're recording this in August of 2024. They're talking about lowering interest rates. So, there's the idea there is the economy has kind of slowed down. We had this really just mad push. Yeah. People were spending money, and obviously we went through COVID, and the economy's kind of been really in this kind of more interesting period. We've had really low unemployment, but a lot of other things going on. And so they're looking at now lowering interest rates to start to curb things like inflation and curb that now that people's spending has actually slowed down. And that's really what they're trying to do. But the side effect of that is all the investment stuff that then affects your retirement.
All right. Which seems excited about lowering interest rates, right? Because a lot of people borrow money. I get that. So I have your, did you know for this, right?
Love
because
your did you knows.
Because right now we're all like, oh my gosh, interest rates are so high. But did you know they are, they've been higher at different periods in history? Of course you know.
I mean, I had a general idea. They were higher, 5 years ago.
According to Fred, which
Who's
is
Fred? Is Fred the guy on the statue? He's the statue guy?
Yeah, he's the guy on the outside that gets the information through the mail slot because there are no windows. Okay.
Oh. Hello, I'm Fred. Pass
exactly.
Your note
yeah, exactly. So the lowest interest rate that
Wait, who is Fred, by the way?
Federal Reserve Economic Data.
Oh, okay.
Okay.
Cool.
So they just compile and get all the data of the history of the Federal Reserve. Fred. The lowest interest rate that's ever been is 0.25%. And that was in December 2008.
I was going to say 2008 or 2009.
Right after the financial crisis, right?
Okay.
And the all-time high since the Fed has existed.
Hold on. I want to guess. It's got to be sometime late 70s, early 80s.
Yes. In March of 1980, it was 20%.
Oh.
So everyone that's over here like wincing at 6-7%, apparently the early 1980s were a rough time to be borrowing money.
I was going to say.
It was also high when my parents bought their house. It was, I think it was double digits. They had the interest rates were double digits then, but their house was only $15,000.
Yeah.
Yeah, there's so many parts of all of that, right? It's such a complicated system. But I looked at the graph for what it was, and historically, it's always been higher than what it is currently, or around what it is right now. We've seen since 2008 two distinct periods where it kind of just totally bottomed out, right? 2008 and then 2020,
and then after COVID,
we had the pandemic. But the average rate is 5.5 over the entire history of the Fed. 5.4. So is from what it has been even since 1970. So overall, that's where it should be. So I think maybe we just have a little bit of what in the HR world is called recency error.
Oh, I was going to say recency bias.
Yes.
I know that term.
Yes.
Hey, there we go.
So we just need, if you get a larger, deeper perspective, as unpleasant as it is, it's not totally bizarre.
And I think
the current rates.
You nailed something perfectly. So there are a lot of people now that owned a home in the 80s, had a mortgage in the 80s, paid 15, 16% on their mortgage, and then now are complaining about paying 7%, which is historically average for a 30-year mortgage. Just because in the last few years, they were able to get a 3 or 4% mortgage. Now, it doesn't make it any easier since, like RJ referenced,
since home prices are totally skewed to what they used to be proportional to incomes.
I'll pay 15% on $15,000 instead of 7% on $500,000. That's and we can have a whole episode on talking about that itself, because wages hasn't kept up and all of that. It's just it's really challenging right now, especially for first-time home buyers, the younger folks that are just kind of getting established. But yeah, I think a lot of recency bias. Interest rates are actually really in a very reasonable place right now. I think the Fed will probably cut them here in the near future a couple times, get them down. They will not probably get down as far as they were a couple of years ago. So when everybody was refinancing and buying homes and getting 2.75% mortgages, I don't see that happening again. If it does, hey, rainbows, butterflies, it's a great time to borrow money. But even if mortgage rates get down into the 5s again, it's going to be a really nice change from where we are now.
All right. So we've talked about who the Fed is, what happens when rate goes up, what happens when rates go down. And it does play a role in your retirement, not just your current situation. So we do have some homework, which is what you said, is basically, this is really simple homework. Just watch to see if the big man pushes the up arrow,
pushes
or
the button.
down. Yeah, pushes and lets the white or black smoke out of
is your homework for
chimney.
people to watch TV? Is that what your homework is?
Maybe
watch
I don't know.
Friends, Cheers, and the Fed Report.
Check for the telegram that comes through the mail. I don't know. However you get your interest rate news.
How you get your interest rate news? Yeah. Talk to your advisor, ask questions about it. Yeah. And it's something that's plastered all over the news nowadays.
Do they meet on a regular schedule? Is it quarterly?
Yeah, they meet. The Fed, they all work together, but they have like an actual Fed meeting every month.
Okay. So it doesn't, it's not like,
no, it's a pretty regular thing.
Okay.
And we had a period of time where we had a Fed chairman who always talked about lowering or raising or moving interest rates. And then they had their meeting and they were
nothing happened. Yeah.
Nope, nothing. And then Bernanke, who's our current, Powell, who's our current, Jerome Powell, who's our current Fed chairman. A lot of people don't like him, and I love that. People on both sides of the aisle don't like him, and that means he's doing a good job. He has been very direct, very honest. He does what he says he's going to do. And he's, the Fed is supposed to be, I know it's called the federal, but it's supposed to be federal government, separated from the federal government. It's supposed to have nothing to do with politics, Congress, any of that stuff. But there's always this layer of pressure there, right? We're in election year. Hey, wouldn't it be nice if we could cut interest rates and say how great the economy is doing before the election, stuff like that. But Jerome Powell has been just ignoring everybody and doing his thing. And we're still not technically in a recession after dealing with everything that's happened since COVID is statistically amazing to me.
It's because he has those really thick fortress walls with no windows. Obviously.
Yeah. He's the guy when you do the little, that's Jerome Powell's direct
Obviously.
assistant. And then he does it. Yeah.
Very clearly. Yes.
You have great visuals. You should write a book one day, I think. Not about the Fed, obviously, but yeah. But maybe a kid's book about the Fed, and you can use the statue as your representation. Yeah.
Yeah. Okay. Yeah.
Yeah. When you're not busy doing this or dealing with me or.
Yeah. Well, first I got to figure out CDs and bonds. That's my personal homework.
Oh, I can't wait to get home and talk about it.
Maybe not immediately. Okay. So that's all I have to say about interest rates, or all Nick has to say about interest rates for today. So,
all right. So homework, we're going to watch TV, just pay attention to interest rates. Don't just watch the stock market, pay attention to the bond market. for your portfolio. And yeah, for more information or for any questions you have or anything, go to the website, sunrisewealthadvisors.com. RJ knows we're all over social media, LinkedIn, Facebook. I was going to say Twitter. I think I'll do that the rest of my life. X. I think we're even on Instagram. Every now and then you can catch me just rapping about CDs and interest rates. That's what everybody wants to hear.
That's why we all wake up in the morning.
Yeah. Well, you're welcome.
Yeah.
Yeah.
Right.
So yeah, I think that wraps us up here, and then we'll, I don't know what we're talking about next. Do we know what we're talking about next?
I was going to ask you that. What's the next podcast? And now you
it
beat me
is,
to it.
You'll have to tune in to find out.
Oh, cliffhanger. What? She's amazing, isn't she?
Yes,
cliffhanger.
Absolutely.
Wow.
Absolutely.
Me, I would have just gave out the candy for free, but no. Tune in next time for more from Becky on her visuals on what the Fed is.
And Nick, for your wisdom. We're going to tune in for your wisdom. How about that?
Yeah.
Okay.
I do what I can.
Okay. Looking forward to your next podcast. And thank you for listening to today's Can I Retire Now podcast. Until next time, for Nick and Becky, I'm RJ Malik.